Hi there, my name is Dan Rawich. I am the founder and CEO of University of Options. We teach people how to trade options safely, minimizing the risk as much as we can, and we try to simplify it as much as we can for our students or our members. One unique thing about us is when you become a member, you trade live with us. You're literally in the same trading room with myself and my trading partner Lee, and you're trading right alongside of us. We're watching the same chart, and I'm telling you when we're entering. Prior to getting there, you'll also have a very, very strong education on options. This webinar slash class is just to cover the basics of stock options so that you'll know enough if you do decide to come visit us in our trading room, you'll know what we're talking about. That's my number one goal. And if you don't join us in our trading room, you should still learn enough about what stock options are to make this well worth your time. So just a quick background on myself. As I mentioned, I'm the CEO of University of Options. I've been trading options and stocks, derivatives, bonds, futures for about 40 years. Out of college, I went to work for Bear Stearns in New York as a bond trader. And later, I was moved back to San Francisco from New York, which is something I really wanted. And I became an asset liability manager. My number one job was to help banks balance their assets and liabilities. Because what crashed banks, our savings banks in the 80s, early 80s, was that for 30 plus years, these banks were making fixed rate mortgages at rates of call it 5%. And then when the inflation hit in 1981, interest rates went to 17%. So think about this for a minute. The bank is only going to collect 5% for the next 30 years on that investment they made, 5%. And now they're paying out their depositors 17%. That was a negative spread of 12%. How long can you go making that much less than you earn? Not long. The banks ultimately crashed. And so my job was to stop that from happening in the future and hopefully help those that were going through it at the time, making sure that all their investments matched their liabilities. Makes sense, right? And that was done with a lot of hedging and derivatives and use of options. So that's enough about me for now. I'm not going to go through these slides too much. I'm mostly going to be talking about or showing you real world examples. But the topics are going to be: what are stock options? What are the benefits of options? What's a call option? What's a put option? How do you know when to buy one? How do you know when to sell one? How do you calculate your profits? And then I'm going to teach you how to paper trade right alongside of us. So let's just jump right in. And I think to start with, I'm going to open up my brokerage account. And this way we can we could do a better job talking about options. So, sorry, I got to log back in here. All right. And let's pull this over to this screen. Okay, there we go. I think I can blow this up for you. All right. So to begin with, stock options, buying a stock option and buying a share of stock are very much the same thing. So let's say that I have Wells Fargo here. This is Wells Fargo Bank. And you can see here the stock trades for $39.65. So if I wanted to buy 1,000 shares of Wells Fargo Bank, I better have $39,000, right? Or I can buy a stock option for 42 cents in this case. Why is it so cheap? Okay, let's talk about this. First of all, if I think the market's going to go up, I'm going to buy a call option. Call options will appreciate in value alongside of the stock. Put options on the right side are what we buy when we think the stock is going to go down. We don't care which way the market goes. We'll buy a put option if we think it's going to go down. We'll buy a call option if we think it's going to go up. We're going to go through some reasons why we may believe either one of those things are going to happen. and we happen to have an extremely high win rate, over 82%. Time in, time out, we win 82% of the time. And that's because we have a pretty good system and we know when to buy a call, when to buy a put, and how long to hold on to it. But one point I want to make here is notice all these different numbers here. Now, I didn't mention this yet, but humans tend to shut down when they hear new terms. Don't do that. Stay with me. You're going to hear a few new terms, and I'm going to simplify them. But if you shut down as soon as you hear the term, you're going to have a hard time learning it, okay? So stay with me. I promise you that you will understand these topics as long as you stay open. Okay, so all of these numbers here are considered strike prices. And what that means is I can buy, if I think that Wells Fargo is going to go up a whole bunch, maybe I'm expecting a $5 move in the stock, so I think the stock's going to go to $44.65. I can go here and buy a really cheap option. I can buy this one for 5 cents. But the stock really has to move a lot, or this thing is not going to be worth anything. Or I can pay a whole bunch of money. Let's say here at 30, I can buy the $34 strike price, and I'll make a lot of money on a small move. So let's use a $5 move. Let's use a $3 move. I think it's more realistic. Let's pretend we believe that Wells Fargo is going to go to $43. And I think it's going to happen pretty fast. And I'm going to go through these dates next. But for now, let's just say I believe between now and April 21st, 5 days from now, Wells Fargo is going to be worth $43. So we'll start off by saying, well, what happens if I buy this $40 one right here and I pay 42 cents for it? Okay, I'm gonna buy 10 of these. So I'm gonna buy 10 call options with a $40 strike price expiring April 21st. This is going to make sense. And I'm going to pay 42 cents each. So this is going to be an investment of $420. Now, options trade in contracts. So when I said I'm buying 10 of these, I'm not buying 10 shares of stock. 10 shares of stock would cost about $4,000. I'm buying 10 options, which cost $400. And each of these contracts holds 100 shares. So for this $400 investment, it's the equivalent of buying 1,000 shares of stock. Each option contract is 100 shares. 10 contracts times 100 shares is 1,000 shares. Each share of my option contract is costing 41 cents. So 10 of these is $420. Okay, so let's think about the difference. I can buy the stock, 10 shares for 4,000, or I can buy 10 contracts for 400. The difference is that the option price is not going to move quite as much as the stock price, and nor should it. I'm paying 10% of the cost of to control these shares. And so what this number right here is telling me is for every dollar that the option, the stock price moves up, my option is going to go up 41 cents. So I'm going to make 41 cents on the dollar, whereas if I own the stock, I'm going to make 100 cents on the dollar. But I got to spend $40,000. Sorry, what are we buying? 100? Oh, we're buying 100. I've got to buy 40,000 shares. Spend $40,000 on these shares, or I can spend $400 on the options. And all brokerage accounts have this ability right here. So if I hit this button here and I hit analysis, and I'm going to pick a date, because remember, this option contract is only good till April 21st. On April 21st, it expires worthless. So let's say what happens on April 20th, right? The day before expiration. If the stock goes to 43, right? We said we think it's going to go to 43. So if the stock goes to 43, then, oops, I've got to change one thing here. There we go. If the stock goes to 43, my $400 investment, see it up here, is going to be worth $2,700. So a $3 move in stock made me $2,700 on a $400 investment. That is 7 times return. 700 times return on the investment. If I were to buy the stock and I spent the same and I bought the same amount of shares, 1,000 shares, because that's what my 10 contracts controls, 1,000 shares cost me $40,000. If the stock goes up $3, I've made $3,000. Think about that. $40,000, $3 move in the stock price, I make $3,000 for a $40,000 investment. It's not bad. It's about 8% return. But for the same 1,000 shares, I can spend $400 and make $2,700. Which would you rather do? Okay, so now let's pretend. So that's what happens if we buy a strike price right about the same price the stock is. We call this at the money. Stock is close to 40. My option strike price is 40. Well, what happens if I really want to be speculative and make a smaller bet? I can buy the $41 one, and now 10 of these is $140. But watch, it's going to be worth a lot less because my investment's a lot less. So if I go to Curve, go to $43, and you can see I still made $2,200 for a $140 investment. It's the return is so much better. Let me make sure I got that right. Nope, I'm sorry, that is not right. I got to change this again. This keeps changing itself. Okay, so it's very much the same answer. $2,000 profit for a $140 investment if the stock goes up $3. Granted, $3 is a pretty decent amount to go up, but it's very possible. Look what happened to J.P. Morgan on Friday. It went up $10 a share. Now, J.P. Morgan sells for about 4 times, 3.5 times. But if you take, relatively speaking, this $9 move was about $30 on a $40 stock. Okay, so back to Wells Fargo. Now we know we can take a really baby risk. But here's the problem. Maybe I'm thinking, I don't really know if this is going to happen by April 21st. And guess what? If it doesn't happen by April 21st, look what happens if the stock stays at $41 at expiration. This is what we're talking about. I've lost the entire investment. I've lost $140. It says minus $139.88. So the stock cannot, oh, that's at 41, I'm sorry. If the stock stays at $39.65, I've lost the entire investment. Okay, so the stock has to go up, or I'm going to lose what I pay for this option. I can't lose more than this, but I can lose this amount of money. Now, maybe I think, wow, that I don't know that the stock's going to get this high between now and Friday. So I'm going to go out a little bit further. I'm going to spend a little bit more money. And my choices are, I can go all the way out till January of 2025. I could control 1,000 shares of Wells Fargo for almost 2 years if I wanted. And let's see how much that costs. Are you kidding me? So I can buy this $40 option. I can buy 10 of these. Let's go to 10. And for $7,000, I can control 1,000 shares of Wells Fargo for almost 2 years. What do you think could happen to Wells Fargo in the next 2 years? Anything. It could double. Of course, it could fall hard, but if it falls hard, I can never lose more than what I pay for these. And frankly, we use stop losses. We're never even going to take that much risk. And so now this Wells Fargo could go down, it could go up, it doesn't matter. But as long as it goes up above $40 between now and January 2025, I'll make money. So much safer than buying 1,000 shares of Wells Fargo. Okay, the most I could lose is 7,000. If Wells Fargo were to drop 30%, which it has not long ago, I'm going to lose $12,000. Okay, what if we'll do something a little more reasonable? What if we go out to May 19th? Typically, when we're making a longer term bet, oh, you can see I actually bought shares of Wells Fargo on Friday. Why? Because they had a really good earnings announcement, and I believe the stock will continue to go up. But let's look at the same idea. I can go out and buy this strike price here. Well, let's look and see what my own investment's going to do. How about that? So I think I can go to analysis. Now let's do it this way. So again, I'm going to buy 10 contracts. Each contract is 100 shares. So I'm going to control 100 shares of stock for each contract, so 1,000 shares. And if the stock were to go to, let's use the same $43 number, let's see what that would be worth. So in this case, it's worth $1,300 if the stock goes to $43. But again, that was a $290 investment. Okay, so hopefully you're seeing how the leverage works. Let's look at it in reverse. Let's look at, let me find a good one here. Well, how about General Motors? General Motors is selling for a similar price as Wells Fargo. And let's say that I have a hypothesis that General Motors, they're going to announce their earnings on April 25th. And I think it's going to be a disaster. I'm not saying that it is. It's just hypothetical. So I want to make sure that I'm controlling the stock on a downward bet that gets me through April 25th. So to be safe, I might buy this contract right here. This is going to give me 33 days to hold these option contracts for Wells Fargo, for GM to go down. And let's see how much they cost. Now we're going to go to the put side, because we buy puts when we think the stock is going to go down. So let's buy one. Remember we said at the money, what that means. So if the stock price is $34.48, this option's at 34, it's right at the money. Opposite of call options, the higher the stock price, the more expensive these things become. With call options, the higher the stock price, the lower they are, because we're betting on that option. We're going to bet the stock is going to go down. So I'm going to buy this $34 strike price. And this number here tells you how much it's going to move. The option is going to move for every dollar in the stock. So if GM were to go down $10, I would make $430. Okay, so I'm going to make 43 cents on every dollar the stock moves. I don't think I got enough sleep last night. Sorry, guys. All right, so what's this thing going to be worth? Go back here to curve. And let's say in this case, we think that the earnings are going to come out. They're going to be terrible, and the stock's going to go to $34. Sorry, $30. Come here, and you can see, oh, that's for one. We're going to buy 10. Not a very big investment. $1,400. Remember, that's controlling 1,000 shares. If you buy 1,000 shares, you're going to spend 34,000. So we're going to spend 1,400, not 34,000. And if the stock goes down to 30, our investment's worth, I can't do this again. Our investment is worth $2,700. $2,700 for a $1,400 investment. We doubled our money, and we doubled it potentially in days, as long as the stock does what I think it's going to do and the earnings get clobbered. If I bought 1,000 shares of the stock and spent 34,000, and the stock went down $4.50, so if I in this case, I have to short the stock, which is a whole nother conversation, but still, I'm going to make $4.50 per share times 1,000. That's a $4,500 profit on a $34,000 investment. Sure, I $4,500 profit is better than what I showed you, which was 2,800. But for this, I'm going to spend 34,000 to make 4,500, or I can spend 1,400 to make 2,800. You see the leverage here; it is unbelievable. And if you're wrong, your losses are going to be much less, provided you understand how to use stop losses and how to know when it's going against you. And those are all the things that we teach. So we buy puts when we think the stock is going to go up. We buy calls when we think, oh my goodness gracious, we buy calls when we think the stock is going to go up. We buy puts when we think the stock is going to go down. Okay, I'm going to summarize a bunch of stuff here now. Options contracts are different from buying shares of stock for the following reasons. Number one, they have expiration dates. Shares, you buy them, you hold them forever. Yay. But you're going to spend a whole bunch of money to buy and hold those shares. So that's number one. Options expire, shares don't. You can control a stock for 2 years, or you can control a stock for 5 days. It depends on what your horizon is. A lot of active day traders would never buy beyond this April 21st. In fact, if we were trading GM on tomorrow, right now it's Sunday, on Monday, Tuesday, Wednesday, we're going to buy this April expiration. That's long enough. I plan on holding the shares just maybe an hour, sometimes just a few minutes. So why here I can buy remember, at the money, stock's trading at 34.48. This is 34.50. I can buy this guy for 67 cents a share. And if I'm only going to hold it for a few minutes, why not? Or if I go out to May, I buy the same thing for $1.55 a share. So this is 2.5 times more expensive. Why spend that money if I don't think I'm going to hold the shares that long? I mean, it wouldn't be a bad thing if I have a lot of capital to buy this. That way I could hold it longer if I wanted. But we typically, the shorter term trades we take, the shorter term expirations we buy. And this is a really difficult concept for new members because it doesn't really matter. And you look at this and you'll think it has to matter, but it doesn't matter. What matters is if I want to hold this option longer, I'm going to pay a whole lot more money, but I'm going to have the security of holding it longer. If I think I'm going to hold it a short time, I might as well buy a short time. That doesn't mean I can't go out longer and still sell the shares in a minute or two. The expiration date has nothing to do with where I buy and sell it. I can buy a June expiration and sell the stock in 1 day and make the same amount of money if the stock moves as I would if I bought a 2-day expiration. Okay, so number one, options differ from stocks and they have expiration dates. The longer we plan on holding these, the farther out we're going to go. Let's stay there. Next thing that the options differ in stocks is options are sold in contracts, not shares. So if I wanted to control 1,000 shares of GM, I would buy 10 contracts. And if I wanted to buy 10 contracts with a May expiration, and I wanted to buy them right at the money, remember, this is 35, this is 34.48, that's pretty much where the money is. If I think within the next 33 days this thing's going to do really well, it doesn't matter which one of these I buy. The more I spend, the more I'll make in dollars, but I spent more, so my return on investment is going to be lower. Let's just use this example. I guess we were talking puts here. So we're going to buy this put at the money, and we're going to buy 10 of them. And we're going to assume the stock goes down to, let's just use 32. So it's going to go down 250. That's a very, very possible if their earnings are bad. So 32 is my target. It's what I think is going to happen. I've decided to go out 30 days. That's plenty of time. I'm going to try this 34 strike price to see how that would perform for me. What this means is this strike price means every dollar the stock moves, I benefit by 43 cents. Okay, so let's go back here and let's see what happens at $32. And you can see my $1,400 investment is going to be worth about $1,200. I'm looking at the P&L theoretical here. If I hold it till expiration and the stock stays at 32, I'm only going to make 600. And the reason for that is there's value in the time. If I sell it faster, it hasn't decayed. Remember, these things become worth less every day as we get closer to expiration. Why? Well, in 31 days, this option is completely worthless. So in 30 days, it's worth less than it is today. And in 29 days, it's worth less. And in 28 days, it's worth less. So we always have to make sure the price is going to move faster than the time decay. That sounds a little more technical than I want it to, but for now, let's just look at these numbers and know that if by April 20th, Wells Fargo drops to 30, GM drops to 32, I'll have made $1,133. That's if I buy this one at the money. But what if I want to go outside of the money, take more risk but spend less money? So now it's only 42 cents. 10 of them is $420. And let's see what that's going to be worth if the stock goes to $32 by the 20th. So if I slide over here, is 32 the number? Yeah. So in that case, if I sell it by April 20th, I make $300 for my $400 investment. Pretty good. It's like 90% return on my investment. So I still make money even though I invested a fraction of what I did in the other ones. The other one I purchased, the first one, was going to be worth, was it $2,800? Let's go back here. And if we go to this one, we can see here at $32, oh, it's worth $1,200. Okay, so almost 100% return on my investment. I make $1,200 here for a $1,400 investment, or I make $350 for my $420 investment. So I can make 4 times more by investing more. But if I don't have the capital, why not just buy these cheapies? You just have to be sure that the stock is going to move. If it doesn't move, then you're going to lose the value of your option. Okay, so that's a little bit on the financials. The idea being you buy puts if you think it's going to go down. You buy calls if you think it's going to go up. Okay, so let's keep going through the difference between stocks and options. So just again, to recap, options expire, stocks don't. You can buy a short-term expiration or a long-term expiration. Long-term expirations are much more expensive, but they're safer because you have time. Like, remember the real estate purchase option. If I'm going to give you $10,000 to buy your house at $200,000, I'd rather have that option for 10 years than for 10 months. Same thing with options. So I would feel it's a safer option to option your real estate for $10,000 if you give me 2 years instead of 1 year. The longer I have, the better. Same thing with options. But the longer I have, the more expensive it's going to cost. So that's options expire, stock prices don't. Options come in 2 flavors, puts and calls. Options have various strike prices. You can spend a lot for the option and get much more benefit, or you can spend a tiny bit and get smaller benefit. But oftentimes your return on investment, because this one was so cheap, this was $400, and I was going to make $350. What's that return? You know, it's pretty spectacular versus spending more and making more. So it's all about your return on investment. Okay, so now what we're going to do is we're going to talk about reasons we might buy puts and calls. I mentioned that I bought a Wells Fargo option on Friday, and I bought JP Morgan as well because their earnings came out really good. And very often when earnings come out good, the stock is going to continue to appreciate for the next 3 to 4 days. It's kind of like a nice tailwind happens, and what we try to do is ride that wave. So I'm going to bring up my charts here. Let me slide this over here. Now, there's a lot going on here. Hang on, this is not showing. Where is it? Sorry, I'm missing an indicator here. I'm going to bring up a different chart so I don't have to rebuild this one. Nope. Okay, let me drag all this mess over here. And we'll go here. Okay. Actually, this has a little more on there than I want it to. I just want to make the chart look nice and simple. Okay. And we're going to go here. Okay. So in the mornings, every morning and every afternoon, we trade live with our groups. I mentioned that earlier. And we predominantly trade two things, SPY and QQQ. Why? Well, SPY is an index. It's an ETF, exchange traded fund. When I buy a share of SPY, it's the same as buying a fraction of a share across every share on the S&P 500. So one share of the S&P kind of gives me the benefit of owning every stock that trades on the S&P. So I don't have to bet on an individual stock. The reason we like the SPY, a couple of reasons. One is we never want to trade against the market. So what that means is if the market's going down, the last thing you want to do is be buying calls. Because if the market's going down, then there's a very high probability that virtually every stock is going to be going down as well. You've heard the term a rising tide lifts all boats. Well, a receding tide will ground all boats. So we like to buy the SPY because it is the market. As long as we're staying with the SPY, sorry guys, that was the dogs. As long as we're staying with the SPY, then we know that we're staying on the right side of the market. Also, the SPYs, one expires every single day. Remember, we talked about expirations, and the shorter term expirations are a lot less money, and a lot of our members have smaller accounts. So on Monday, tomorrow, I can buy a share of SPY that is at the money. So we'll call it this the 413 because the stock is 412.50. So this is pretty close. You can call this at the money. And I'm going to buy 10 shares of this. We're going to hold this thing. We're going to hold this thing maybe less than a minute because in the day trade room, we are scalping. We are in and out so fast. We take very little market risk. We wait for the right amount of momentum. We wait for the buy signal and we jump in and we jump out pretty fast. So let's say that we're in the trade and the SPY moves 50 cents. We can see how much we would make in that regard. Oh, that's at limit. That's, hang on, sorry, I've got to change a couple things here. Okay. I had to change the date to the 17th because this thing's going to expire on the 17th. So if I hold this beyond one day, it's going to be worthless unless it goes up a lot. So let's say in this case the stock goes from 412 to 412.50 to 413. That's not a big deal, not a big move at all. And oh, it's not working on a one-day demo. I've got to make the move a little bit bigger. Let's make the move 414. This thing's really designed to go further out, not same-day expirations. All right, we got to go 415. Okay, so if the stock goes to 415, my 10 options that I spent $1,100 for are going to be worth $820. That's buying one-day options. If I want hold it longer, I can go out longer. But every day, these are days, this thing costs more and more and more. Okay. So, but if we're just scalping and we're in and out in a few minutes, why not just buy today's? So if you have a small amount of capital, you can trade more contracts, which is going to make you more money. Okay, so I'm going to talk about a couple things. Number one is kind of basic technical analysis, and I know that's a big word, but what you need to know is stocks are always trending. They're either sideways, trending up, or trending down, and it's not too difficult to see. But sometimes you have to back away and really kind of see the forest through the trees, or the trees through the forest, or whatever that is. Now this is a 1 minute chart. Every one of these candles is 1 minute. And when we're live trading in the room, we're watching every single candle. And let me show you what we're looking for. So I'm going to scoot this up here. So notice that the stock went up here and it stopped. And it stopped and it stopped and it stopped. And then it hit this level and it pulled back. And this level is about 412 and 15 cents. Why is it stopping there? If I look back here, I'll find that there were other times that it stopped here. Do you see that? That number, for whatever reason, look at this. It just keeps stopping the stock. Ultimately, the stock might climb above it, but you can see that is a really important level. Now, I didn't have to go backwards to see that. I know right here 3 or 4 times it stalled out, and that was a problem. So I'm not going to buy the stock below here. Not right on top of it, maybe down here, but not right through here, right? Now, the other thing that's been happening is the stock it's only been falling right here. And you can just draw a line. You can see it hits here and it bounces back. And so it's trending sideways. Stocks are always trending sideways, or up or down. Now, this level here, again, I didn't know this when I drew that line, but look at how important this line is. So we know that history, when you're trading stocks, will almost always repeat itself. And what we know is we don't want to get involved here. This is where traders lose all their money, in these ranges. We're waiting for a break. And this bear signal, that means it's going to drop. This is our proprietary system called Flight Station. So we look for this bear signal. We also want to see this blue thing come down, and we want to see this reddish thing go up. So when this thing triggered, it also blew below this 411.70. This is a signal we would absolutely take. And as you can see, it came all the way down to 410.60. So this was a $1 move in stock price. That means we would have made $50 for every option contract. Okay, because you're going to make about half as much on the option contract as you would on the stock. So $1 fall in stock price. If I had 1,000 shares of this, by the way, that would cost me almost $500,000. And a $1 move here, I would make $1,000. Yep, $1 times 1,000 shares, $1,000. If I own the option, I'm going to make half of that much. But instead of spending $400,000, I'm spending, we're going to go out, well, let's go out back one day here. We're spending $1,100. So I'm spending $1,100, not $4,000, not $400,000. Ooh, I'm really out of it today. And the stock moved $1. So 1,000 shares would make me 1,000, but if I bought the options contract, I'd make $500 on whatever that investment was. That was 1,100. Yep, 11. I make $500, and you want to see how fast that happened? Remember, each bar is a minute. So we entered the stock on this bar here. This is where our signal, this is our proprietary system, said get in. So 1 minute, 2, 3, 4, 5, 6, 6 minutes. I made $500 for an $1,100 investment. Okay, that's because I bought a put. Now, let's go back here and say, all right, we ended up back in the same zone. And the last time it broke out of here, it broke down. This time, it broke up. So if I enter on this breakout here at 412.70, you can see the stock went to, whoops, hang on here, 412.10, and it went to 412.70. This was a 70-cent move in the stock, or $35 per contract. 10 contracts, I made $350. 10 contracts only cost $1,100. Okay, now my system actually triggered, told you to get in way down here. So in actuality, this move was $411.30, $1.40. This was $70 a contract. 10 contracts, $700. 20 contracts which only cost $2,000, $1,400. 30 contracts which only cost $3,000, $2,100. Okay, but there's an example of sideways movement. Now the next thing we're looking for is a trend. Which is the stock trending up or down? And we're looking for a break in that trend. So all you have to do is connect the bottoms of each of these moves like so, and you can clearly see it's in an upward trend here, and then I can connect the tops too if I want here. And what I can see here, let me scoot this in some. I can see here that this is a pretty good channel. And so as a trader, every time it touches this line, now I don't really know it's a good channel here yet. You need 3 or more touches. But by the time it came here, I know it's a good channel. And guess what? My system triggered a buy signal right off the line. And you know that it's been going up the channel, down the channel, staying in the channel perfectly. So you could enter this trade at about 411. You can see the prices over here. And it went all the way to the top of the channel at almost 412. So this was another dollar move, $500 per contract, staying in the channel. And then all of a sudden, it stopped. It hit this level, and we talked about this level already. Now we know this is an important level. So the next time it broke above that level, we knew that that was a good thing. Let's talk about a downward channel. So once the stock broke out, it formed a downward channel and or trend line. And so if I just connect the tops of these, I just need 3 or more touches. I have my touches. I can see where it broke out here. So not only did my system give us a buy signal, it broke above this downward trend, making this a really good signal, and up it went, and it went up a lot. Let's do a couple more. This is as easy as it looks, guys. I see this going up. I'm going to just draw a line to connect all these candles so I can see exactly what the trend line looks like. Guess what? It broke here the same minute my system gave a sell signal. So we have this great confirmation of breaking a trend and me triggering a sell signal. Here's another one. It began down way up here. So all I'm going to do is connect the tops of all of these. My system triggered a buy signal, and it broke above the trend. Actually, it broke above a little bit closer. It broke above the trend on the very next candle. So flight station, my system says get in. We broke this downward trend. Of course, you're going to get in, and up you go. And this happens over and over and over all day long. Here, we're stuck sideways, right? You can see it keeps hitting this top, hitting this top. By the way, this was the same line from way back here. I am going to adjust it slightly just to capture these tops. And then you can see how it stayed in this really tight range. You wouldn't want to be trading in this range. If I get a bull signal here, meaning buy a call, do I really want to do that when I know this line is treacherous? Because this line was was stopping the price from falling. That's support. Support and resistance are the same thing. So this same line that stopped it from dropping is stopping it from rising. I'm not going to buy a call when I know it's about to bump its head. And then I'm not going to buy a put when I know it's going to stop falling right here. I'm going to wait until we get a break. So all of these get ignored. And then this bear signal triggers here at the top and it falls through the line here. And you can see it just continued to fall. You might have exited here when you saw this signal, but this is what that looks like. So if you got in here, which you would, ride this down, you're going to get out here, and then it re-triggers a bear entry as it broke back below here. Okay, and some of these trends are really, really long. If you want to know, I'll show you. You know the market crashed beginning December of last year, or the year before. And we're going to take a look at what that looks like here. That is that's already the 20th. Okay. I'm going to get rid of all these lines. And I want you to see something really important. So, was it 22? Yeah, well, I think we collapsed the year before that, 21, but let's go with 22. So my money was was invested, in a longer term portfolio, and I'm always watching these trends, and this one became a really important one because it goes and it goes and it goes. So you can see how many times it touched and held. This was a massive trend line that created massive buys every time it touched. Now this is a day chart, so these moves that look on the 1 minute chart, this might be $1. On the day chart, if you bought it here at 436, it ran up to 469. This was a 35-point move. $1,700 per contract. I trade 40 contracts, so this was a $7,000 move. And it kept working over and over and over. And then one day it broke. And it broke in January. And when this broke, I took half my money and I went in, I got out of the market. And then it fell and it tried to climb. And when it failed here to climb above here, think about this. This made a lower high and this made a lower low. And what that did was it began to construct this downward trend, which turned out to be a massive trend, other than it did bounce here a bit. But once this failed right here, I went short with the rest of my portfolio and I stayed short, and I'm still short. Because I still don't think this thing is over. I think there's still room for this market to fall. Just because of stock earnings are falling. So that's a bit about technical analysis. It's about a bit about our system. And I'm going to talk about two other things that I think you'll find helpful. Because you have to join to get this. But I want to help you even if you don't join. And I want you to be able to understand when to go in and when to come out of a stock. So now you know what a trend line looks like, whether it's sideways, up or down. We're always looking for breaks in these trends, because when they do break, it's always meaningful. Right now, you don't have to be a genius. You can look at this and say, at least on the short-term chart, because this is still just the 1 minute, we know it's range bound. We know that. Why? Because it got stuck here and here and here and here. Same thing. It got stuck here. It couldn't fall any lower. I can tell you that these lines probably become important somewhere else. For instance, right here. We touched this line here and it fell hard. So this is a really important support line. I'll bet you if I keep going, yep, there it is. My upper line, look at that. I couldn't draw that any better. Now we know we are in a very important range, and we should expect it to stay in this range until it doesn't. Once it breaks, we'll buy it. So here's a bull signal. My system's saying buy it, but we know we can't because we keep hitting our head here. But when it breaks above here, it's going to look just like this. It's going to run up just like this. Same thing with a bear signal. I can't take it because I know how important this line is. But if I get a bear signal and then I fall through here, well, then I know it's going to fall hard. Okay, history will almost always repeat itself. All right, I'm going to show you a secret that might be one of the most incredible things that I could show anybody. It's a long story how I came to this, but I'm going to show you how to create this and one other thing that will help you know when to buy a stock. I'm talking pure technical. No, I'm not talking about earnings. I'm not talking about news. I'm not talking about rumors. I'm talking about just what the chart tells us. And I think now you know the charts don't lie. As traders, we don't trust them enough, but they don't lie. They're almost always going to be true. So I'm going to start with a blank chart. And I'm not being overly dramatic when I tell you this is maybe one of the most incredible things anyone could show you as it relates to the market. Okay. By the way, tradingview.com, set up a free account. You don't need to spend any money, just get a free account. And when here you're going to see indicators. And we're going to start with something called RSI. So where that blank up there, RSI, and I'm looking for relative strength index right here. Okay. Now, when you open this thing up, it's not going to look like this. Mine's customized. I'm going to show you how to customize it. When you open it up, it's going to look like this and this. Okay? That's what yours is going to look like. Now, this is not where the magic is. So what we're going to do is we're going to make a couple of changes. Now, you can customize this indicator by going right here into settings and into style, and we're going to change that line into a column. And then this one, RSI based MA, we're going to change that line to a column. And we're going to do one other thing. We're going to go, while we're in settings, we're going to go to input, and this is going to say something else. This is going to be like 14. You're going to make this say EMA by using this drop down window, and you're going to make the length 8. That's just clicking it like that. Okay, that is going to set you up for the first important part of what I'm going to teach you. Okay, next, the free account only gives you three indicators. So we're going to use, I'm going to show you how to add 2 of them, but you're only going to be able to use one at a time. So I'm going to start with the more important one. So you're going to go to indicator and you're going to click on EMA. Oh, I just thought of something. Never mind. You're going to go to EMA and then a 4. Where did my mouse go? I just lost my mouse. Okay, that's really weird. Oh, there it is. I pushed it way away. And we're going to look for this one, moving average exponential times 4. So you're going to click on that, and I'm going to show you how to set it up. Now we're going to go to settings again, just by hovering here on this little gear, and we're going to make the first one an 8. We're going to make the next one a 21. We're going to make the next one a 50. And we're going to make the last one 200. Now, I always use the same colors. You can use whatever you want. I like my short one, 8, to be white. I like my next one to be purple. I like my next one to be like a magenta. And I like my last one to be like a light blue. Okay? Now, what are these things? The blue line is the average of the last 200 candles. So this is like just smooth the price out over 200 candles. The magenta line is 50 candle smoothing. So if you're using a 1-minute chart, then this is an average of the last 50 minutes of candles. The purple is 21 and the white is 8. So now I'm going to show you buy signals. They have to be, a couple things have to happen. First of all, the white has to cross the purple. And when it does, it has to be above the magenta. Okay, so right here is a pretty good time to enter the stock. Now see this purple? We call this Barney. When Barney comes out of his cave, that's already going to be a pretty big buy signal. So Barney came out way down here, but we wouldn't want to enter because it's still, the lines aren't clear yet. And we want these lines to have a clear separation. But when this white crossed the purple, this is all this is. You don't even have to know why. But when the 8-minute average 8-minute white line crossed the average of 21-minute white line, that created a buy signal, and it was confirmed by Barney. And you can go in that trade, and you could stay in that trade until it closes below the white line. I don't think anyone's going to really show you this. Certainly not down here. So first thing is, I see Barney. I'm ready to buy, but I know that the white has to cross the purple. It does. It's above the magenta, and up we go. I mean, it couldn't really be much easier. Now it kind of flattens out, nothing's going on. Barney comes out a few times here, but notice how you don't have any kind of a crossing of the line. So right now we're talking about just buying calls. So here you go, Barney comes out and the white crosses the purple and it gets above the magenta line here. Wow, what a great signal. I think we looked at that one already. Here's another one. Barney. This time Barney came out right when the white was crossing here. All good. What we don't want to do is we don't want to take a long signal, long meaning buy a call, when the price is below here. So, and it won't happen too often, but if we want to buy a put, here we go. The white crossed the purple and it was now below the magenta. And in this case, we don't want to see Barney, and we do want to see his cave getting smaller. And you can see this just kept going down and down and down, and it kept you in the trade until here. So you enter when the purple crosses the white, and you exit when the price closes below the white. So you would definitely be out here. Let's look at another one. I can do this all day long. White crossed purple. Barney was out and ride it all the way up until it closes below. These are really big moves, guys. And it doesn't matter what the stock is. It works for all stocks. So if I were picking a stock right now, and I'm not even adding our proprietary system, FlightStation, which gives you the ultimate confirmation. I'm just showing you part of what we do, and that part in itself works pretty well. So Intel right now, the white line came under the purple and it just came back out the other side, and Barney just came out. What else can we see about Intel? Well, it's been in this upward trend that started down here, and it stayed in this trend line. And it's got a top to the trend line, which makes it a channel. So what do we know? We're pretty certain that the last times it's touched these sides, it's gone to the other side. That Intel probably will rise to, you know, up here to the top of this channel somewhere. So that's probably a pretty good trade here. Now, you don't need my system, but it's way better if you do, because it'll exactly tell you if there's a buy signal or not at the bottom of that channel. If there's a buy signal down here, I can feel much more comfortable about white crossing purple and Barney coming out and all that good stuff. So I'm just going to quickly put in our proprietary signal. Again, this is kind of for members only. Takes a minute to populate. There it is. Okay, see the buy signal? Right on the line. I mean, it's really confirming everything I just said, and my system flight station is telling you exactly when to get in. Guess what? It also tells you when to get out. So here we touched the trend line, we got our buy signal, and this pink arrow told us when to get out. Got in here, white was already above the purple, pink told us to get out here at the top. Okay? Now, last but not least, I wish the market were open right now. I could really show you this better. We're going to talk about paper trading. So let me get rid of this. Okay, when you have your TradingView account open, and by this is all free, everything I showed you, you do not need a paid account for. Next thing is you're going to click down here where it says Trading Panel, and you're going to click on Paper Trading and click Connect, and click Connect. Now, if you're trading with us in the morning or just practicing what I'm showing you here, this is what you want to do. When you see this bull signal, you're going to right click, you're going to go to Trade, Create New Order. And if we say we're buying calls, you're buying. Now this is really trading stock, but it doesn't matter. The idea is to learn to trust these signals. So when we see a buy and you're trading live with us, we'll say I'm going in here. And all you're doing is you're clicking here and you're buying. Now I'm going to get an error message because the market's closed. If the market were open, that order would fill. You can track your success. So when you set up your paper trading account, you're going to get $100,000 of fake money. Mine shows 150. My paper account is up $50,000 just from teaching people these signals. And if you click here on account history, you can see how much is made or lost on each trade. And what you can see is there's a whole bunch more green than there is red, a whole bunch more. And for the most part, the green numbers are going to be bigger than the red numbers. Not always, but the point is we've run this thing up $50,000 in the last few months. So the system really does work. By the way, some of these, and this is not like, trying to make excuses. A lot of these losses is because I'm teaching and then we go on to another lesson and I forget to close these. And that works both ways. But generally speaking, this is what you're going to want to look at, and you're going to want to make sure that you're up all the time. Don't start trading real money until you're winning almost every trade. Our members, once they join, we beg them to paper trade for a minimum of a week, and we ask them to show us their account. It's not like I'm trying to micromanage, I'm trying to help. And so if their account is down after a week, well, they haven't perfected this yet. Why would you start trading with real money? You don't. We beg people to paper trade. Sometimes we get members reach out to us and say, Dan, I'm struggling. I went from paper, I was doing great, and then I started trading with money, and now I'm not. And my answer is always, go back to paper. You're just not quite there yet. And guess what? Sometimes I have a bad day, and I'll paper trade the second half of the day. Why? Because it just builds your confidence and proves to you what we have works. Now, our system's been back tested over 2,000 trades. We know if you enter here when it says bull or bear and you exit on the pink arrow, you're going to have an 82% win rate. But our system, again, you have to avoid these. And how do you know to avoid these? I don't think it's very difficult. Which, by the way, we have another. You won't be able to have all this on your paper on your screen, but hang on here. Here it is. Okay, these dots. When we get a bull signal, meaning buy a call, you can't go in until it crosses the dot above. And so what does that look like? The dot was right here. We never entered the trade. So if this is a false trade, we didn't fall for it. Here's a sell signal, and you're going to enter it only below the dot. And in this case, it did come through the dot, and it did make you money. Here's a bull signal here. It has to clear the dot. Once it clears the dot, it's a confirmed trade. In you go, and up it goes. Bull signal here has to clear the dot before you go in. Clears this dot here. So you wouldn't have fallen for any of this. You would have gotten in here and made money. It really gets rid of all your fake signals. Here's a sell signal. Great. We can't go in it until it clears the last green dot. We didn't fall for that one. Here's a buy signal. It has to clear the last red dot. We didn't fall for this one. So these dots keep us out of trouble. And it's using the dots plus down here plus our buy signal is how we get that 82% win rate. Okay. Well, this was a pretty long session. I'm going to now start answering some questions. Hang on, I'm going to pull those up. Whoops, I lost myself here.